Today on the CEO Barbecue, Amerigo Resources is back. And Amerigo is a company that makes money from the waste material of the world's largest underground copper mine. For a bullet point summary of this and all other CEO interviews, please go to resourcetalks.com and subscribe to our free weekly newsletter. The company you're about to hear from has paid us for the production of this interview, but this interview is still intended only for experienced speculators because this is venture capital and mining is a very risky industry where failure is the norm. All conversations are general and impersonal in nature, and they contain forward-looking statements. I'm not a licensed financial advisor, and my business sells content-producing services, which also makes me biased. So before continuing on, please talk to an independent investment advisor with a good long-term track record because your capital is at risk, and also visit setterplus.ca where you'll find the company's official filings. If you're not 100% sure you understand all the biases and the disclaimers that I just showed you, please go to the last section of this video and do not consume this content unless you fully understand and agree with everything said herein. That all said, Amerigo is not an actual miner, though, itself. They don't have mineral rights, they don't have a mine, and they don't extract any ore from the ground. They do make money, though, as I mentioned. So they make the money that they make comes in from a copper concentrate, which they extract from the reprocessing of the tailings of Codelco's El Teniente copper mine in Chile, which is the world's biggest underground copper mine. Now, I'm not doing a full company overview here because this is, again, not Amerigo's first time on the barbecue, and Aurora and I went over the basics behind the company in a lengthy interview a couple of months ago. I'll link that interview below this video so that if you haven't watched it yet and this is your first time hearing about the company, you can go ahead and play that one first. Amerigo is listed as ARG on the TSX main board, where over the last 3 months, actually since we last spoke, the average volume has gone up a lot, and it's now at about 750,000 shares for the average 3-month volume. That's about 3 times as high as a couple of months ago. The stock's 52-week high is quite different as well. It's at $5.70, and its 52-week low is $1.57. With a market cap of just over 905 million Canadian dollars and close to 161.5 million shares outstanding. Today, this is a $5.60 stock with a 50 and a 200-day moving average at respectively $3.97 and $2.61, which means the stock is now trading well above both of them. And as you might have noticed, trading very close to that 52-week high. And as a matter of fact, very close to that all-time high because a couple of things have changed since our last conversation to generate that much more volume and that big of a price increase. And we'll talk about all of them today, but really to make that conversation possible, I will have to shut up now. And Aurora, I will let you do the talking. But first of all, thank you so much for being here today.
Thanks, Antonio. It's nice to chat with you again. I enjoyed our first interview more than probably 6 months ago now. But time flies, and it's good to have the opportunity of giving an update now.
The pleasure is mine. Time flies when you're having fun, and a lot of fun is being had at $6 copper, I suppose. Let's maybe start with that price and volume increase, though, that I mentioned here. Is this all market beta with copper running to $6, or is there something that you've done as a company to generate that much interest in the stock?
I think it's both. I think that obviously we are a copper trade. That's the underlying commodity that makes or break the company. So at stronger copper prices, there is more visibility into us just because of us being a copper producer. It's not just Amerigo. The peers are also getting a lot of attention. What distinguishes us, and I would say what has still positioned us to provide better returns than peers, is our stage in corporate maturity, where we're basically a mature company that has grown to its full production capacity in our current installation at MVC in Chile, as you mentioned. And the fact that we are not a capital intensive operation anymore. And we, essentially are a reliable and very predictive operation in terms of the production pattern that we have year on year. And when you have that stability, low capital intensity requirement, and strong copper prices, blended together in a perfect smoothie, then it's not unrealistic to have the level of attention that we're having. So I think the generalities of the market that are common, the commonalities of the market that we are all sharing in the copper space is one of the drivers, but also how Amerigo uniquely can respond in a totally different way to that trigger point of stronger copper prices is what has given us this, attention at this point in time, which is well deserved, if I can say that.
If you do say so yourself. If is the stock price at an all-time high and the market cap close to $1 billion, making it uneasy though? I mean, based on your answer here, I don't think that's the case, but do you feel like it's getting ahead of itself here?
No, no, I don't think so. I think that we have been very patient and very consistent in telling our story for the last 5 years as copper prices have been rising, as we have shown to the market that we have a stable operation, that we have a predictable cycle of cash flow. Our modeling perhaps is one of the easiest modelings that you can find in the copper sector altogether. You have an annual production target that we're usually meeting or slightly exceeding. You have a cash cost, and we provide a full array of our guidance, including the capex that we expect to expend. So at the end of the day, it's even become an easier story now that we're debt free. So if you pull out two news releases from us, the first news release of 2025 and 2026, and you analyze the changes and trends, you can come up with a pretty good Excel model in about an hour. So I think that simplicity of the business, when you just factor in stronger commodity prices, both specifically copper in our case, because moly, we do produce it, but it's a byproduct for us, then you come up with a very obvious story that has to be reflected on the share price. So we're very happy to be able to confirm that additional visibility is starting to be recognized in the marketplace. But I'm not surprised or sleepless by it, thinking, oh my gosh, we've created something that is not sustainable. That is absolutely not the case.
I also want to talk about the future and maybe a little bit of your guidance, upcoming catalysts and stuff like that later on. But it might be worth actually picking it up from that Q4. Your Q4 financials are relatively recent here. Record quarter, big pile of cash, no debt anymore since Q3, even I believe. Correct. What made this record quarter though, the Q4? Is it higher throughput, better recoveries, better grades, just the copper price itself, partly everything together? Yeah, what made this a record quarter?
Well, we haven't yet disclosed the financial results. We basically just disclosed operational results and provided, well, what was the production in the quarter and the cash cost. So let's not factor in copper price yet, because we haven't disclosed it. It's coming up at the end of February when we disclose our full annual audited financial results. But a couple of things to note. In general terms, the Q4 is always a stronger cycle, a stronger quarter in the year, just because of the mine sequence that the mine has. So we follow up on that. But in 2025, we saw our stronger results essentially coming in from higher recoveries, both in the fresh circuit. We produce tailings from the fresh material that is coming from the El Teniente mine. And we also produce tailings from historic tailings that are deposited adjacent to our plant. So both of those had very good recovery rates. And I would say it's mostly as a result of some optimization projects that we did in the year in 2025 that have come online and that are giving us good results that are factored as well into our increased guidance for 2026.
Mm-hmm. Well, when I saw the numbers, production numbers, and you're right, the financial numbers are not out yet, but one could only assume, and I'm doing that, I am assuming, it made me think, is this performance sustainable long term? And really what I'm asking, or why I'm asking that, Aurora, is because of what happened at El Teniente earlier in 2025 in the summer, I believe, where a seismic event, I suppose, and a rockfall led to Codelco to suspend operations. and you had temporarily stopped receiving fresh tailings as well. So where I'm going with this is, was this Q4 just a catch up to that event, or is it something that you can sustain long term over 2026 as well as beyond?
It's not a catch-up event. It's not as if we suddenly got more throughput of fresh tailings. We actually didn't. If you look at our Q4 news release, the throughput was lower than normal on the fresh tailings volume. So it's basically driven by higher recoveries, as I mentioned. I think when we spoke last time, it was on the back of our Q2 operational results, and you had some specific questions about the quarter. And I basically mentioned when you look at Amerigo, you should think about the year, not the quarter, because there is changes from quarter to quarter. And I don't measure our performance based on what Q1 or Q2 have done, but on what the full year has done. So if you were to ask me, Aurora, is 2025 an anomaly that you don't think you're going to be sustaining production-wise? The answer has already been given in our guidance for 2026. We're guiding a stronger guidance for copper and for moly than ever before. So that's and you know that we're a cautious group. We're not over promotional. We're not promotional, even not forget about the over. So if we issue a guidance, it's because we feel comfortable with attaining that guidance.
Yeah. That's fair. You are not in promotion. It's actually funny when you said forget the over. How was 2025 from a cost perspective? You have published that. I know you published what, $1.93 cash cost. If I
$1.93, including the cost of our union negotiations contract cost. And 189 without that factored in. And it only happens every 3 years. So that's why when we differentiate between our cash cost and our normalized cash cost, that's the only item. We don't have a long list of things that, some issuers exclude everything and then they come up to a perfect cash cost that basically includes nothing. So 189. Yeah, it actually came in below our guided normalized cash cost, which was $1.93. So it's not a huge change, but just keeping within the parameters of what we expected, in terms of operating cost, and the cash cost is a driver of that capture of operational performance on a cost basis. We're very pleased with the results for 2025.
That's where I wanted to go with this. Is that I don't almost standardized metrics in the industry. I don't really trust. I mean, people for the all-in sustaining cost, people have almost free reign within reason. But so that's where I was going with this is that, and I'll ask you this question as a caveman, but at what copper price would you have made money? Like if you had a $2 realized copper price as a company, would you still make money?
A $2 realized copper price? No, probably not. I would say $2.80, $3 in terms of making money.
Yeah.
We're not that concerned about just that factor. We have a capital return policy that is now embedded into the DNA requirements of the company. So we consider that. Just as other miners need to cover their sustaining capex, which is substantial, we need to cover ours, which is not substantial, and we need to cover our CRS as well.
Mm-hmm. Yeah. That's still strong. $3, making money at $3 is still strong, especially in this environment. Does part of that, well, I know that part of that cost strength does come from molybdenum byproducts. So it did this year. How much of it, like how much of your strength cost is dependent on molybdenum?
Moly did help our case in this year, not so much on the price, which is a great way of explaining it, but on the increased production that we had on moly. We guided $1.3 million of production for 2025, and we achieved $1.5 million, which is the same amount we're guiding for 2026. And that's coming as a result as well of the optimization projects that we carried out. They have benefited both the copper circuit and the moly circuit. There is more moly content in the historic tailings than in the fresh tailings, and we work more with historic tailings in 2025 as a result of stabilizing our production results as a result of the accident that occurred at El Teniente, which limited some of our throughput. So we were able to adjust and optimize final output from our facility by adding just more processing of historic tailings. But the fact that we're essentially keeping that new floor of 1.5 million pounds of moly in 2026 is quite important. As I mentioned, we still don't have the financial results out, so I cannot give you the specifics of the percentage of the moly revenue to total revenue. It's never over 10%. Let's put it that way. That's just one way of saying that. And when you're talking about cash costs, and this is always so confusing to people that are not accountants, the cash cost metric is, an anomaly. It's not a financial result driven metric. And in the cash cost, we factor in the moly revenue as a moly byproduct credit. So people get confused because we are reporting it on both as a cash cost reduction and as a revenue component. Yes, but those are two different books. Like one is a financial report and the other one is just this mining convention called the cash cost. So yes, the moly has an effect on our cash cost, and we always guide for it. In our news release, we say for $2 change in moly price, you would have such and such an effect on the cash cost. So that should help people model out their personal Amerigo model as well.
You're doing a bit of a public service here too, at the same time, while also promoting Amerigo maybe a little bit, because you're right. I mean, cash costs are not. I've seen people, look at production and then multiply it by the current spot price and then subtract the cash cost per pound. And then they're like, oh, that's what the company's going to make. And then they are always like far above that. Wouldn't it be wonderful if that was the case? But it's not.
And a lot of accountants would be out of work if that was, if that was the case. Yeah.
But then they could buy the stock and nobody would have to work, because if all the mining companies were making that much money, we'd probably all be a little bit happier. They say money doesn't buy happiness, so that maybe that's not even true. Where's that cost projected for 2026? How much money is it going to cost you to put out a pound of copper?
$1.93 is our cash cost guidance for 2026.
Yeah. What about that break even cost? Because you said it's probably close to 3. Is that going to go up, or would it stay around the same level?
It would go up marginally, just as the cash cost went up marginally.
Right. Okay, that's fair. What is the biggest driver actually of potential cost increases? Like, is it your COP, reagents, energy, maintenance, something else?
It's the foreign exchange relationship between the Chilean peso and the US dollar, because most of our costs are in Chilean pesos. Labor, all the maintenance contracts, services, a lot of our spares components, the smaller spares are bought in Chile and are priced in Chilean pesos. So if there is an appreciation of the Chilean peso to the US dollar, that is a cost driver. And we also have guided for that. First of all, we expect a stronger Chilean peso in 2026 than in 2025, and we've guided an exchange rate of 900 Chilean pesos to the US dollar. It's not there yet, so we're again being perhaps a little bit conservative, but that's good. And so that would be the main driver. It used to be years ago, and some people that have been with Amerigo for decades as shareholders still check out the power cost, because power was a big wild card back in the day, but it's not anymore. We have locked in our power rate to 2037. We only have US CPI adjustments on the power rate, but there's another component of power costs that we have to face. All industrial consumers in Chile have to do that, which are called pass-through charges. And pass-through charges capture some of the efficiencies or inefficiencies of the public grid system, and they are priced as well in Chilean pesos. So, with the higher rollout of renewable energy, which is a plus in many ways. It also is a less reliable source of energy for a lot of consumers, not for us. We're not affected by it. But the grid has to respond with some redundancy mechanisms, and we all get to pay them. So we've seen an increase in pass-through charges as a result of that. And as I mentioned, they are in Chilean pesos. So I would say what is out of our control, and that's, before you ask me, will we hedge the Chilean peso? We will not hedge it, but we are just aware that that is one of the drivers that that has an impact, potential impact on our cost structure.
You're stealing my thunder. I thought that was gonna. I was like, that's the question that's gonna make
That
me
was
seem
your
smarter.
sophisticated question. No, we don't like to hedge copper. We don't like to hedge Chilean peso exchange rate.
Yeah.
A cycle is a cycle. A business. We have to be focused on what we can control, and hedging ultimately is a great business for the people that sell you the hedge.
That's another thing that might be more difficult for non-accountants to understand. But you're right, especially in this environment. I think where copper is and where it's potentially going. Fair points. Does it cost you to more to process historic tailings? Because you said there's more moly, so that's credit. But does it cost you more?
It does. It does because in the case of the fresh tailings, they're coming to us. They're coming to the MVC plant by gravity from the mine. So there's zero transportation costs, and they're coming in the form of a slurry. So it's a wet material that has to be a slurry because it's coming, kilometers up from the mountain down a concrete channel to us. So there has to be it has to be transportable. In the case of historic tailings, they're dry tailings that we have to recover hydraulically with a lot of water. So we have the cost of the water, and we have the cost of the power to have that, let's call it rehydration process, and then pump those historic tailings to the plant. So we spend more money on the historic tailings for sure than with the fresh tailings.
Mm-hmm. And this might actually be a point to go back to what happened at El Teniente, because why I'm asking that is because I'm thinking, could you find yourself in a situation in 2026 where you have to process those historic tailings again or mix that in? How exceptional was the situation or the happening at Codelco? Is that something that could occur again? Is it something that you could even plan for?
We cannot plan for it, and they cannot plan for it. The situation of full stoppage of fresh tailings at MVC is very unusual. The situation of what occurred at the mine itself is very unusual. They hadn't had this type of accident in 30 years. So that's the unusualness of it. What matters in terms of our what we can control at the MVC level is having that flexibility of either adding more fresh or adding more historic. And the opposite occurred in 2023 when there was a substantial amount of flooding in Chile, and we had a power stoppage. I think we discussed that in our prior call, so I don't want to spend a lot of time on that. So because we need more power to process the historic tailings, we didn't process historic tailings until we could secure our full power input in, and we were focused on the fresh only. So those are imperfect conditions that have almost perfect solutions, because the total imperfect scenario would be a full stoppage of production. And we haven't faced a full stoppage of production in real terms for any long period of time.
Yeah. What are some other things that have that stem from that happening, if any? I mean, I know you signed I don't know if it's got anything to do with it, but you signed a 3-year labor agreement with MVC's Operators Union, which runs up until the end of 2028, I believe.
Correct.
Is it related to that event? What's the reasoning there?
No, there's nothing stemming or that event didn't trigger anything other than our re-engineering of how we were going to be working in the fourth quarter. That's essentially it, and it turned out to be a pretty good, perhaps. Motivator for us to ensure that those optimization projects were giving us as much as they could. The labor setup in Chile is very predictable. Most mining companies are unionized. We have two unions. We have a union of workers and a union of supervisors, and they negotiate at different points in time. Their contracts have different initiation and termination dates, and all contracts in Chile are 3-year contracts. So every October of 2025, and the next one will be 2028, we sit together with our union leaders and have a discussion and decide on what the terms of that collective agreement will be for the next 3 years. There is a component called the signing bonus, which is significant, and that's why we exclude it from our normalized cash cost, because that's a component that's quite important for the workers in the sector in Chile to receive a substantial signing bonus when the contract is renewed every 3 years. I've received a number of questions saying, well, with higher copper prices, will the workers ask for more now? They have an agreement. They sign up an agreement. They're well taken care of. Our workers are well taken care of, as are most workers in the mining industry in Chile. So there's no risk of them coming in and saying, "Oh, we think that we have to renegotiate." That hasn't ever happened in the Chilean setup. Chile is a wonderful country in that sense, in terms of the lack of wild cards that occur. It's not Peru. It's not, it's different. And the people that operate in Chile know that.
You would have then like an automatic wage escalators or bonuses or something else in those contracts?
Within our normal labor agreement, our workers get their wages increased to the Chilean CPI every 4 months. So they have 3 salary reviews every year to keep them to keep their purchasing power at par with inflation in Chile. And our workers also get, as part of their normal compensation, a production bonus.
Yeah. Okay. Well, really, where I was going with this, though, was thinking of, are there any safety or compliance changes post the El Teniente accident, or anything that could burden you or spill over into your bottom line?
No. Basically, there is no sort of big post-mortem at the industry level, because all the safety measures that needed to be had were there and were basically mitigators of something that could have been substantially worse. So the system worked. It was not that the system was broken. The system worked and mitigated an event into something that was regrettable, but significantly less of a less impact than it could have been had those tremendously detailed and meticulous safety requirements not been in place.
Royalties. We talked about DT having a sliding scale royalty last time as well, which is, it's maybe not as straightforward to understand, at least not if you're supporting my level of IQ. So how much were total payments? I don't know if you can talk about the financials.
No, I guided for what we expect to have next year. The royalty payments are a significant part of our business. That's the reality, and it's always been like that. El Teniente makes more out of this operation than we do. This is not new. It doesn't happen at higher copper prices or lower copper prices. It's just the way it is structured to be. So that's nothing new, and everybody that has been looking at our financial statements from day one knows that. So that's the reality. And it's good. They own the tailings from beginning to end. They let us work with their tailings. By doing so, the agreement provides us with that unique business model that we've that I was describing, low capital intensity once the initial capital has been put in place. So they are partners in the business through that monetization of their tailings. That's for sure. And that's why we exist. So it works for both parties. You were asking about the sliding scale. We have, in fact, yes, at higher copper prices, there's a higher royalty factor. It reaches a limit, and we have reached that limit, which is $4.80 per pound for the fresh tailings. So right now we're having our discussions with El Teniente on what that factor will be above the 480. For the historic tailings, it's 550 for 2 consecutive months. We're not there yet, but one discussion will probably lead to the next discussion. And it's good. It's great to have these discussions at higher copper prices. We've almost had them at lower copper prices, and you feel better having the discussion at higher copper prices.
So, but essentially, when the price goes from 4 to 480, that has more impact, or you get to keep less of that upside than it does when it goes from 480 to $6.
Yeah, the slope of the scale cannot continue going up indefinitely, and that's why those price ranges were set up, because that's where that progression rate doesn't make any more sense, so it has to slow down.
Yeah. Okay. What's the I know nobody likes thinking about it, but what's the worst case outcome of a royalty factor discussion with DET for shareholders? I mean, short of contract termination, which I don't think is reasonable to expect, but what is like if you don't agree on how this goes forward, what's kind of the worst case?
There's really no worst case. If we don't agree, if Team A being MVC and Team B being El Teniente wouldn't agree, we have to go into arbitration. And we have to abide by what an arbiter says. So the long-term viability of the contract is not in play. It's basically just one number, and that number has to make sense to both parties.
Right. That's fair. And it's not only royalties that you've been paying. You've also given money back to shareholders over the last couple of quarters. You've announced a special dividend recently. You've increased your normal base dividend, and you've also retired close to 4 million shares, I think.
Yeah.
Is this a plan for 2026 similar to that approach, or?
That is a plan for 2026. Nothing has changed. That CRS structure is well designed to work for us in this higher copper price environment as well. So we've already raised the quarterly dividend. I don't expect a further increase in the quarterly dividend. It was raised 33%, so we're now paying 4 cents Canadian per quarter. One of the reasons why we did that structural change was because we have no more debt to service. So there was that additional room that is, it's obvious. So we could increase that dividend without feeling that there was a risk in not being able to sustain it in the long term, which, as you know, is our biggest objective with the quarterly dividend, is to have a number that works through the copper cycle and that doesn't have to be adjusted. So we adjusted it, and I don't expect anything to change on that in 2026. So that leaves us with share buybacks and with performance dividends to work with. And I think we've also mentioned our minimal commitment on the share buyback program is not to have dilution, or at least not have dilution year on year. And we beat that in 2025. We have a net reduction in our share count. We expect to have a net reduction in our share count in 2026 as well. We're active on the buyback program right now. We're recording mid-January before we go into our blackout period. When we go into the blackout period on the 20th of January, we'll have to stop our buybacks until we resurface after releasing annual results. But we're active on the market, buying back our shares at today's copper price.
Well, you say it's obvious, but is it really though? I mean, because you could do other stuff with that money as well. You could be looking for potentially diversifying the operation, so getting a second operation, or just capex in general. So what's the hurdle for you? Like, how do you decide between buybacks and special dividends versus capex or growth?
That's an easy question to ask because on CapEx, we look at CapEx in three different silos. One is a sustaining CapEx. Sustaining CapEx for us is not that capital intensive, but it's critical in terms of what it does to ensure operational continuity. So just to give you an example, right now, as we're starting 2026, our engineering team is already identifying what will need to be included in the sustaining CapEx for 2027. So this doesn't get presented at a budget meeting in December at the end of the year. We have ongoing discussions through the year. We review our risk matrices and determine, this is an open area where we need additional, risk mitigation, reinforcement. These structures need to be changed before they fall or break or whatever. So sustaining CapEx is quite important. The other one is risk mitigation. Per se, and risk mitigation are the red flag projects. We've had two big ones in the last years that we undertook before we had a problem. One of them was the risk of flooding. The risk of flooding could have cut off our infrastructure, our conduction pipes from the tailing sump into the concentrator plant in an event of a flood. So before the floods of 2023, we invested money to wrap those pipes in flotation equipment that have kept them floating while we had the flood event and for months afterwards as well. And the other one was the purchase of a third power transformer, because we have two on site, and if one of them had failed, then we could be without, with major disruptions in our processing capacity, with limited power restrictions or limited power feed. So we invested in a new transformer, and those weren't cheap projects, but those let us sleep much better at night. And the third bucket of a CapEx is optimization. So optimization CapEx is what can we do to have more reliability through our process to ensure that variability does not continue to or is reduced. And there are interesting, intelligent projects. They're projects that are very creative from a metallurgy perspective, because we're looking at the finessing, the real finessing of stages of our process, how we can capture, for example, more fines materials, how can we reduce the variability of the size of the particles in a certain stage of the concentrator, so that we can have more liberation of material. It's just almost it's very meticulous work. It's not that CapEx intensive, although this year we're spending about $6.4 million on optimization projects. But it basically pays for itself quite rapidly. The payback period for the optimization CapEx that we have this year, I think we have one project at 1.4 years, one at 1.7, and one of the projects has a 3-month payback period at $4.80 copper. So they are good projects. They don't compete with the CRS because they actually are promoters of the generation of more free cash flow once production levels are increased. So before discussing what will be happening in terms of sort of the free cash flow component, we attend the CapEx component, because you cannot have a facility like MVC and not invest in it, in its safety, in its continuity, and in seeing how you can continue to optimize it. Once we've done that, then you move on to what is a free cash flow, and the discussion is done at the board level, and we determine what will be done for the next 3 months in terms of share buyback activity, and the residual cash then becomes a trigger for a performance dividend.
Yeah. So it's sustaining optimization and risk capex. Essentially, that's how you'd classify
Yeah,
it.
risk mitigation is always, the sort of the red flag. We don't have any risk mitigation projects for 2026. We don't have any identified risks that needed to be attended. But we're always looking. We're always looking. And right now we're having our annual plant shutdown this week. It is a time when we shut down the full production process. We conduct a lot of preventative maintenance, but it's also a lot of inspection work. So a lot of the capex that will be carried out on a program basis through the year comes out of what we see when you shut down 8 mills and your workers can go inside the mill and check exactly how the liners are doing and everything else. That gives us a lot of data points and information about how we're going to be working for the next 12 months.
Last time we spoke, I think, correct me if I'm wrong, you told me it was 13 million a year, those three combined, so sustaining optimization risk. Now 2026, it's 17 and a half. What's changing?
We have more optimization capex, and that's why we broke it down in our news release, saying this is a sustaining component and this is the optimization component. And shareholders, don't worry, we're not spending money idly or stupidly. Those optimization projects have a reason of existing, and they have very good payback periods.
What's the breakdown? So optimization is the heaviest of the three. So sustaining optimization, risk optimization would be the heaviest, or what's kind of the breakdown?
In this year, it is the heaviest component on its own. Yeah.
Yeah. Okay. Yeah, and then yeah, okay, so you have the paybacks. Yeah, that all makes sense. How do you think about where this all came from? Is kind of like, what do you do with your money? How do you think about potentially expanding the business? I know last time you touched upon it, but has anything changed in your opinion about potentially looking for a second operation?
It's a very easy question. If you talk about looking for a second operation, it would have to be a copper tailings operation. That's the first sort of decision point. That's what we know how to do. We're not traditional miners. We're not gold people. We're not zinc people, silver people. We're copper people working with copper tailings. So that is the first sort of sift. And when you position yourself as a copper tailings expert, MVC is not the only opportunity in the world. There are others, but I always mention that there are three sort of additional factors within that pre-definition of copper tailings. We're looking at the volume. The volume is significantly important, because when you're working with low-grade material, you need the volume in order to make the economics of the process work. The other one is the geographic location vis-a-vis the point of origin of the tailings and the tailings deposit location. In the case of MVC, as I mentioned, we are connected to the mine, but we're also connected to the tailings deposit by gravity. So that's a significant plus. And the third aspect is the nature of the relationship with the owner of the tailings. It has to be a strategic long-term relationship of mutual benefit, as what we have with El Teniente, to make it work. We're not interested in doing a project, as a subcontractor for a fee. That's not our business. We want to have that exposure to the risks and reward of the copper business.
Your standards are not low, which they shouldn't be. That's fair. Have you looked at any projects? Are there any projects that would even?
There are projects, and I think the deciding factor in triggering any initial point of contact is the appetite of the counterparty to even have those discussions. Now, if you ask me, in a $3 per pound copper environment, will a company that has copper tailings be looking at their tailings as with a monetizing view? Probably not. They're interested in other things. They're not incentivized. They're incentivized to survive, not to start looking at what else could be there. When you're talking about a $6 copper price, I think that changed the dynamics, because you probably start looking for copper everywhere you can, right? What do you have in your pocket? Is there some cover change you can sell? So yeah, I think that we're in a very interesting time where, first of all, a lot of operations are struggling just to meet production capacity as it is, let alone grow it. And the realization that there's a potential of recovering additional copper from material that's already there in the form of tailings, and that someone has been doing it profitably for 32 years could be interesting for us and for potential partners.
So you know what you want, and you say that there are assets there that would fit it. Why hasn't it happened yet?
Well, I think that one of the reasons is the copper price incentive as seen by counterparties. And we're also not, we don't have a business development arm with 5 people earning $250,000 that is knocking on doors. That's not the way in which we will be proceeding with any potential discussions. They have to be done basically at the top level with leadership at the companies that are committed to looking at the monetization of their tailings.
Mm-hmm. Is it when you actually do get to the point where you find a potential deal, and you and I talked about that last time as well. You said you'd prefer debt for a potential second plan, not equity dilution.
Yeah.
Yeah. What I'm just thinking, how do you have your cake and eat it too? Like how do you keep paying? Because once you pay a dividend and it's a large dividend, you don't want to stop paying it because you would disappoint people, I suppose, or lower it. So how do you expand while also keeping that financial incentive for people to hold the stock?
That would require some good discussions with bankers. It probably would require some tapering down of the CRS in terms of the additional distributions, but not necessarily the quarterly distributions. We have that experience of dealing with banks and knowing the shackles that banks want to put on your hands. So we're not pursuing, we wouldn't be pursuing any activities that fundamentally change who we are. We would be pursuing activities that enhance what has already been built, not change it and take you back to square one.
Yeah. And where this conversation kind of started is, what do you do with your cash? Essentially, you said that your goal is to have fewer and fewer shares outstanding. You've retired about 4 million, so we talked about that. How is that
4 million in 2025?
Yeah, that's right.
Yeah, I'm just clarifying because we've retired much more than that.
That's true. Yep, that's fair. Or where we're going with this, Aurora, is you do have option packages for management. How are you going to balance that where it's not, you're not, because you're buying shares and then issuing options or RSUs or DSUs and stuff like that. How are you going to balance that where you're incentivizing management enough for them to want to work hard and all that, but also still not increasing that share count?
I don't know if we talked about it before. We have essentially a cashless option plan that significantly reduces the number of shares that are ultimately issued on the exercise of options, because rather than people coming in and having to pay their full strike price and struggling to find the money at more than at the current share price that we have, buying your options requires probably mortgaging your house to buy your options, and then you're selling your options, your shares right away. So on a cashless system, you basically just net out the benefit less the taxes. So the amount of shares significantly is reduced from that top number that you may see of X number of million of shares of options outstanding. Right. So that reduction or that mechanism works great, reduces the number of shares that are issued potentially on options exercise that are on the money. And all of our options are in the money right now. And then we have to buy those back. So essentially, the retirement commitment of year-on-year reductions applies after the fact that some shares are going to be issued in the year.
Mm-hmm. What are the KPIs going to be to determine that for options and for bonuses and whatnot? What is your performance, a kind of top tier management's performance? What does that get measured on? Is it share price or throughput or something else?
I have 20 different KPIs on an annual basis. Yeah. I have a scorecard, and our managers, our CFO has a scorecard, our managers in Chile have a scorecard, and we basically work on that scorecard on a monthly basis to see where things are. Charlie Munger has a great phrase: "Don't ever underestimate the power of incentives." And incentives, our incentive plan pays for itself with management's performance and results.
That's a fair answer. And I don't want to hold you too long, Aurora. What do you think is the biggest risk for the company right now? Or when you talk to some of your biggest investors, what's the biggest criticism that people have of Amerigo right now?
I don't hear a lot of criticism. And again, I'm just being totally honest here with you. We do have some shareholder rotation. Some people are holding shares that are Amerigo shares in big positions that need to be rebalanced within their own portfolios. Family offices, institutional investors, not so much. But when you're talking about retail and family offices, there's an allocation criteria that each group or person or family office has, and they don't want to be overexposed to a stock that suddenly is worth a significant percentage of their portfolio. So there has been already since November, December, some reallocation of those shareholdings that have been quite well absorbed in the market. So it's not a risk itself, but it's a new factor and a new circumstance that we're seeing, and it's present.
Hmm. What about a political risk for Chile? You said you expect the currency valuation to go up. Is that in any type of way related politically or
No,
regulatory?
that's a de-risking. I see a de-risking of Chile. I see there's a new conservative government coming into power in March of this year. It's a change from the prior government, which had much more left-leaning tendencies. At the end of the day, they didn't crystallize, and they couldn't do a lot because, again, as I mentioned, never underestimate the stability needs and desires of the Chilean people. It's a very stable country. It's a very stable democracy. So there are safeguards, Congress, the Senate, et cetera, that keep things in check to ensure that things don't change that much. But it's always reinforcing to hear that there's at the presidential level, there's going to be a pro-business, pro-mining, a pro-economic growth policy being pursued.
It seems like it's all across South America and Central America, maybe not that much, but it seems like there's a swing toward the right or closer to the center, at least away from the left, is what I would call
it.
Away
from the left, yeah, away from the left.
Yeah, that's what you're
what used to be called the center is now called the right, and that's a reflection of how far things left were. But let's not start discussing politics, Antonio.
That is a hilarious thing, and it's only funny because it's true. But no, that's it for me today, Aurora. Thank you so much for doing this. What am I forgetting to ask you though? What did you come here hoping to talk about that I failed to bring up?
You're a good interviewer. You're very unbalanced, so I think we covered everything. And this was not a deep dive into the company as we did before. It's a catch-up chat between friends, so I really appreciate it.
Well, thank you so much for doing this, and hopefully speak again soon.
Thank you.
And as always, thanks to everyone for watching Resource Talks. I have a couple of more things to say, though. The fact that this company was interviewed here today does not mean that they are necessarily a good or a bad company. I'm not here to endorse nor attack anyone. I am simply here to ask some questions. If you find that I have failed in asking a question that you would have liked to hear an answer to, which will happen as I'm not an experienced interviewer, please let me know, and I will try to correct that mistake in a future interview. As mentioned at the beginning, please understand that mineral exploration and development is an extremely risky business. Losing money is the norm and should be the expectation. This is a very complex sector, and the performance of individual companies typically depends on many different moving particles, including company-specific factors like geology, financing ability, and many others, really, as well as particles that are outside of the company's control, like geopolitics, macroeconomics, commodity prices, and many more, most of which are nearly impossible to fully understand. Moreover, these companies that typically get interviewed on Resource Talks are in the pre-revenue stage, which means they rely on the public markets for the financing of their operations, which could result in shareholder dilution. Furthermore, as a general rule of thumb, you'll be better off understanding that all company communications online, albeit this interview or their website and their presentation and their social media accounts, or even the social media accounts which you thought were your friends and then told you about a stock, everything really that these companies do is intended as marketing. And although I do not make buy or sell recommendations because there is a clear conflict of interest given the nature of my business, many out there do. And you should be aware of that inherent bias, and you should be careful out there. That bias is not always going to be clearly disclosed with everyone out there. So it is safer for you anytime you're watching any type of company specific content to approach it with a dose of skepticism and assume that the party telling you about it is biased in at least some shape or form, because there will always be a bias. Again, albeit clear or not. So always ask yourself what the incentive of your counterparty is and never rely on them regardless of their incentives, but instead double check if what they're saying is true, again, by using setterplus.ca. The fact that I have no idea what I'm doing should already be clear to you at this point. I am not saying this to make jokes or laugh with myself. I just simply do not have a long enough track record of consistent investment profits. So I should under no circumstances be considered an authority on anything. Again, although this may sound amusing to you, believe me, it is not amusing and it is not intended as a joke. I'm simply pointing out a fact and warning you not to rely on anything I do or say. Unfortunately, at least to my understanding, nobody out there has any special abilities. The CEOs do not possess any superior knowledge, and they cannot know about what will go up, what will go down, or what will go in circles. Some people even believe that to be rule number one on Wall Street. Nobody really knows. None of us know whether any of the company's activities will result in a success, again, given that we're talking about high-risk activities where most of the times it ends in failure. So unfortunately, try as I may, I won't always catch all red flags or all challenges with the companies. So even if I did ask a few tough questions in here, don't rely on this being all of the tough questions. Again, these are complicated startups with many moving parts, and I am conflicted given the nature of this business. Therefore, I cannot guarantee the quality of anything presented in this video, and you cannot hold me responsible for any losses or damages stemming from the way you decide to use this interview. Viewers, listeners, and readers acknowledge and agree that the information presented herein did not constitute a solicitation or an offer to buy or sell any security or investment or to participate in any trading strategy. Resource Talks and all parties involved in the management of the business strictly disclaim any and all liability for losses and or damages, whether direct, indirect, special, or consequential, or other consequences, however so caused, arising out of any use or reproduction of the content published by Resource Talks or any decision made or action taken in reliance upon it. By consuming this content, all consumers vow to release Resource Talks and all parties involved in the management of the business from all claims, proceedings, or consequences. This is all to say, I know it's a lot of lawyer talk, but this is all to say that you shouldn't blindly trust me or anybody on the internet, and you should do your own research. Once again, social media is meant for entertainment. It is setterplus.ca where you do your research. That's where you'll find the company's official filings, and I encourage you to read and analyze the Management Information Circular, the financial statements, the Management Discussion and Analysis, and whenever available, the NI 43-101 technical documents. If you don't understand everything in those documents, the chances of you losing money are even higher than they normally are in this space. And as mentioned earlier, the chances of even the best analysts in this sector losing money are extremely high, since this is venture capital and it is not for everybody. I'll leave you with one of Charlie Munger's quotes, which I wish I had listened to more often earlier on, which says, quote, "If you don't understand it, don't do it."